In today's video, I'll walk you through real chart examples step by step to show you how liquidity zones work, where retail traders get trapped, and how you can use liquidity sweeps to your advantage. Once you understand this concept, you'll start to see that the market often collects liquidity first and then reveals its true direction. And trust me, understanding this process can completely change the way you trade. So let's get started and learn where liquidity is found on the chart, how liquidity works, what a liquidity sweep really is, and most importantly, how to identify a liquidity sweep, build a high probability trade setup, and wait for the right confirmation before entering a trade. Now think about this for a second. If you knew exactly where the biggest money in the market is hiding, would you still take trades randomly? Of course not. That's the biggest secret behind successful trading, liquidity zones. Once you learn how to identify them, you'll start entering trades in the same areas where institutional traders are positioning themselves. Now, let me show you on the chart exactly where liquidity is hiding. Let's start with equal lows and swing lows. This is where most beginner traders place their buy orders, with their stop losses sitting just below the lows. But that's exactly what creates a liquidity pool. All the market needs is one quick push to trigger those stop losses, providing the liquidity institutions use to enter their positions. Now let's look at equal highs and swing highs. This is where traders usually place sell orders with their stop losses just above the highs. Institutions often target these levels with precision. Retail traders see what looks like a breakout, jump into the trade out of excitement, and then the price suddenly reverses, stopping them out and leaving them on the wrong side of the move. The next liquidity zone on the chart is trend lines and channels. Almost every beginner trader relies on them. They buy at trendline support and sell at trendline resistance. But here's what most traders don't realize. These boundaries often become liquidity traps. The market creates a fake breakout, traps retail traders into the move, and then quickly reverses. That's when the real move begins. Next, let's talk about order blocks and order flow zones. These are the areas where large institutional orders are often placed. Most retail traders see them as nothing more than simple support and resistance levels, but in reality, these are the zones where smart money has already built its positions. Now take a close look at the body and wicks of the daily candle. Whenever you see strong rejection, liquidity is often building in that area because traders place their orders and stop losses around those rejection levels. But the real game begins when that liquidity gets activated. Now here's the most important part, how liquidity actually works. This is where traders either succeed or end up blowing their entire account. Liquidity isn't just about stop losses getting hit, it's the fuel that drives the market. Without liquidity, the market simply can't function. The problem is that most retail traders see liquidity as a loss, while smart money sees it as an opportunity. Think about it. When a retail trader places a stop loss and it gets triggered, that money doesn't just disappear. The market absorbs that liquidity. Institutions, such as banks and hedge funds, use it as fuel to execute their large orders without causing excessive price movement. Now the real game begins. Institutions know that retail traders are highly predictable. When support breaks, most traders rush to sell. When resistance breaks, they rush to buy. And that's exactly where the trap is set. Institutions first create the illusion of a breakout in one direction. Retail traders jump into the move, their stop losses get triggered, and that liquidity allows institutions to fill their large positions. For example, imagine thousands of traders have placed their stop losses below a set of equal lows. The market pushes lower, sweeps those stop losses, and absorbs all that liquidity. Once the institutions have filled their buy orders, the market suddenly reverses and rallies higher. Retail traders think, the market tricked me. But in reality, it was all part of the liquidity game. The next question is, what do institutions do after they've collected all that liquidity? So how does the real move begin? The answer is a liquidity sweep. A liquidity sweep is one of the most powerful and dangerous moves in the market. Simply put, the market collects liquidity first, then reveals its true direction. This is exactly where 90% of retail traders get trapped. Imagine the chart forms a series of equal lows. Retail traders see it as strong support. They buy the market and place their stop losses just below those lows. Institutions know exactly where those stop losses are. So what happens next? The market suddenly makes a sharp move below the equal lows, triggering all those stop losses and absorbing the liquidity. Retail traders assume the support has failed and rush to sell. But at that exact moment, the market reverses sharply to the upside. This is called a liquidity sweep. A fake breakdown first, liquidity collection second, and then the real reversal begins. Now let's look at the opposite example, equal highs. Most retail traders see equal highs as a strong resistance level. They enter sell trades and place their stop losses just above the highs. The market then makes a quick spike above those highs, sweeping the stop losses. Retail traders assume it's a real breakout and rush to buy. But that's exactly where institutions fill their sell orders. Once their positions are filled, the market reverses sharply and drops. This is why your stop loss often gets hunted. Institutions understand retail psychology. They know exactly where most traders place their stop losses. Once you understand liquidity sweeps, you stop thinking like the crowd, and you stop getting trapped by it. Traders, here's a big question. Why does every trade fail, even when the setup looks absolutely perfect on the chart? Think about it. You identify the trend, see that the market is bullish, and excitedly enter a buy trade. At first, the price moves in your favor, but then it suddenly drops, hits your stop loss, and leaves you wondering what went wrong. It feels like the market tricked you, but the truth is, the market didn't deceive you. You just didn't understand the language it was speaking. This is where liquidity market structure theory comes into play. The first step is to identify the trend. Is the market making higher highs and higher lows? If so, the trend is bullish, or is it forming lower lows and lower highs? Then the trend is bearish. If the trend isn't clear, taking a trade becomes a high-risk decision. And that's the very first mistake most retail traders make. Now comes step 2, break of structure, BOS. Whenever the price breaks a previous swing high or swing low, it's called a break of structure. This tells you that the market's momentum is continuing. But there's a trap here too. Don't enter a trade based on BOS alone. Next comes the most critical step, POI, point of interest, and the pullback. Pay close attention. A pullback to a zone is only a high probability entry if a liquidity sweep has already taken place. For example, imagine the market forms equal lows. Price first breaks below those lows, sweeps the liquidity, and then reacts from your POI. That's the type of setup you're looking for. If there was no liquidity sweep, remember this, your POI can become the liquidity instead. In other words, you marked the zone expecting an entry, but the market may simply use it to hunt your stop loss before moving in the opposite direction. So, here's the simple formula for a safe trade. Liquidity sweep plus POI plus confirmation equals high probability trade. Now the next question is, how do you get that confirmation? This brings us to the next golden step, confirmation entry. Let's say price has reached your higher time frame point of interest POI. This is where both excitement and uncertainty kick in. Is this the right entry, or is it another trap? That's why confirmation is so important. Drop down to a lower time frame and study the price behavior. The first clue is a CHoCH, change of character, which signals that the short-term trend may be shifting. But don't jump into a trade based on CHoCH alone. That can be risky. The real edge comes when you identify a new lower time frame point of interest, whether it's a small order block or a supply and demand zone. This is where you can look for your entry because these zones often reflect smart money activity. And here's the most important part. Your target should never be random. Your target should be external liquidity, typically the previous swing high for buy trades or the previous swing low for sell trades. Remember, most traders are always searching for the fastest entry and the quickest exit, but the traders who patiently wait for confirmation are the ones who catch the real move. That's the difference between getting trapped and consistently taking high probability trades.